Hi, everyone. This is Jason Barrett of Wall Street for Main Street. Welcome back for another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. We're recording this interview on Columbus Day on Monday, October 13th, 2025. The oil price has been range bound. It's been in a trading range. It's at the low end of a trading range right now. It's around $60 a barrel, just under $60 a barrel, West Texas Intermediate. Seems like every time there's a rally in the oil prices, President Trump or someone from his administration comes out and says, we're focused on fighting inflation. We're focused on cheap oil and cheap gasoline prices. The natural gas price here in the U.S. has rallied substantially, maybe based on the projections for data centers, which are under construction, these massive next generation data centers, which are energy hogs. Natural gas prices rallied to over 3. Today's special guest, like I said, is a returning guest. He's a former Hess Oil senior executive for many years. He worked in the mergers and acquisitions department. He currently runs the Energy Prospectus Group in Houston, Texas, where he covers a lot of these oil and natural gas energy companies, the pipeline companies, and oil and natural gas growth companies. Dan Steffens of the Energy Prospectus Group, thank you for joining me again.
All right. Thanks for having me.
So, Dan, before we get into maybe some of the details of the oil market right now, I want to get your thoughts on supply and demand because we're on the low end of a trading range right now for oil. Are we seeing any signs that there's actually demand destruction, or why do you think oil prices are so weak then?
Well, I think it's just the geopolitical noise trying to talk down the oil price as much as they can. Like you said, every time it makes a rally, they, start putting out reports that it's going to go lower or there's going to be this supply, this big glut. Well, as of last week's EIA report, all of the petroleum inventories in the United States, crude oil, 4% below normal for this time of year, gasoline, 1% below normal for this time of year, and distillates, which includes diesel and home heating oil, 6% below normal for this time of year. So the market is adequately supplied today, but there's definitely no glut. I mean, we're nowhere close to the situation that you had at the beginning of the pandemic when there was a significant demand destruction, because they shut down all travel. But nothing like that is happening now. And until, and I certainly do not see OPEC plus Saudi Arabia, UAE are the only two OPEC countries that have any excess supply that they can bring to the market. And it's not in their best interest to create an oversupplied market. And U.S. oil production, if oil stays in the low 60s, it's going to decline anyway. It's going to peak in December, and once it rolls over in the first quarter of 2026, once it's confirmed that U.S. oil production is on decline, and I believe that we're going to see that in the first quarter within 6 months, and I think that's going to be a big paradigm shift because I think people believe that this shale oil is just going to keep going up, no matter what. It's just going to keep, and I'm surprised that it's actually held up as well as it has.
Well, they've gotten efficient with the drilling, right? So even though the rig count is down enormously, the rig count's down a lot over the last 18 to 24 months, they've gotten more efficient at drilling the wells. But if I could add to your points here on supply and demand, I mean, some of the news stories that I've seen come out in the last week or two, I mean, Indian oil demand, it's growing like gangbusters.
Yep.
Does it seem like that the Saudis and OPEC are they doing like Trump a favor? Because normally in the past, Dan, I know you've been through many cycles, bull markets, bear markets over the years throughout your career, both at Hess Oil, other oil companies, and covering these companies extensively with your newsletters. Normally do the Saudis and OPEC, do they normally cut production in this type of market at these prices?
Yeah, but I think they see the demand. They see an undersupplied market. Like just today, this morning, the OPEC quarterly report came out, and they see demand going up like 1.5 million barrels next year. They think there's room in the market.
So that's globally. You said 1.5 million globally.
About 1.5 million globally next year, and they still have got U.S. production increasing next year in their model, and I just don't see that happening. I mean, I think it'll flatline. I mean, at the current active rig count, and I will tell you this: if WTI oil goes below 60 and goes to $55 a barrel, you will see all of these upstream U.S. companies just slam the brakes on their drilling programs. They'll go into hunker down, try to maintain free cash flow and whatever. And they hold most of their really good acreage is held by production anyway, so they don't have to drill new wells. And it's stupid to bring these high rate wells online into a low oil price. It's the smart business move is for them to leave those drilling locations in inventory, wait till the price rebounds, and then once you get back to, I truly believe the right price today for oil would be in the 70 to $80 range.
Well, I think the Saudis are going to need that at some point because
Yeah.
isn't Saudi Aramco, aren't they? They've talked about the dividend cut. I'm not sure if they've cut the dividend or not, but they were discussing it. They were taking on billions of dollars of debt to maintain their dividend. And there's charts out there that people are going through the math that they need the Saudi government in order to pay the dividends for Saudi Aramco shareholders, which they said they wouldn't cut. And then
Hmm.
also to fund all their social programs so there's no civil unrest like an Arab Spring 2.0 inside Saudi Arabia. They need like $90 a barrel Brent crude, right, to break even?
Yeah, and they're wanting to make good deals with Trump, and this is all part of the negotiation, probably. But in the real world, when oil demand growth is relentless year after year, it goes up with population growth. Really, the simple formula is whatever percentage the population growth is, multiply that by 1.5, and that's going to be the increase in oil demand because of, in addition to more people, people want higher standard of living, and you only get that if you have reliable energy, and that's going to come with oil and gas. And so, the outlook looks really good. And we could discuss this later, but there's really two markets. There's the oil market, the global oil market, and then there's the regional natural gas market, which is extremely bullish, in my opinion.
So this oil demand growth, the 1.5 million barrels per day, is a lot of it coming from like emerging markets, Saudi Arabia, India. Where do you think
Yeah.
it's come from?
Well, they say really Asia, and they include India in Asia. That's where almost all the demand is going. Outside of that market, outside of what we think in our mind, Asia, China, Japan, Indonesia, that, and you put India in that, that's where all the demand growth is coming from. Outside of that, it's pretty much demand is flat.
Okay, and so the demand, would you say, is it from like people that normally would have used bicycles or walking or public
So,
transportation and what they're buying their first scooter or they're buying a
yeah.
motorcycle or they're buying a small car?
Yeah, I made a presentation with this U.S. Energy group back at the end of September, and I had a chart in there, and I said it shows U.S. People per capita. We use 917 barrels per person per capita of oil-based products. In India, it's 57. So just to get anywhere close, I mean, if everybody in India start riding a moped or something that runs on gasoline, you're going to have a big increase in demand, and that's what it is. And then in China, it's only 140 gallons per person. So to get anywhere close to our standard of living, you're going to see a big increase in demand from those countries in Asia.
Well,
So,
China started at a way lower base. I mean, it's up enormously
right.
over the last couple of decades, though. So, like, I think they've been switching some of their taxis over to electric vehicles, but like their
Yeah.
diesel and the gasoline usage are up, and especially electricity now because of how modern a lot of their cities are, and now they're building data centers too. Like, we're just looking at a new normal of enormous growth for electricity demand. I want to ask you though about the Permian Basin oil production because for listeners out there, that's 85% of all the oil production growth since 2009 or something. It's like a disproportionately insanely large numbers out of the Permian Basin. For low cost producers, are they going to start to feel pain now at $60 a barrel West Texas Intermediate or below, or do you think there's still free cash flow there, or are they going to start
Yeah.
like?
Yeah. The way to look at it is, these shale wells are very expensive up front, but then after they're online, even at $60 oil, the lifting cost or your operating expenses after they're placed online are only $12 to $15 per barrel. So they have huge profit margin, huge cash flow margin. So they can be very profitable and very free cash flow positive during an extended period of low oil prices. And seriously, I updated 6 of my Sweet 16 company forecast models today. I reduced the oil price to $60 across the board in there, and they're all generating a lot of free cash flow. Every company in our Sweet 16 is free cash flow positive if you assume natural gas is going to be $3 and oil is going to be $60, they're still free cash flow positive. In fact, I did one Permian Resources, which is a company I really like, and I took it down to $50 barrel oil, and they're still free cash flow positive because they have some tremendous acreage out in the Delaware Basin, which is the western part of the Permian Basin.
But there is large capex cuts, right? Many billions of dollars of capital expenditure is being cut. So like companies like ExxonMobil, which is one of the largest producers in the Permian after buying Pioneer, and EOG, which did an acquisition recently. So they're announcing huge capex cuts, not for a little bit. It's billions of dollars in capex cuts, right?
Right. Yeah, I think it's going to be a rough period for the service companies until we get past this and can establish some, even if we could stabilize the oil price in the low 60s and everybody would have confidence in that, then you could build your budget and your strategy for going forward. But the problem is it's just flopping all over the place so much that, it just scares investors away. But, there's really, really good companies trading for 3 and 4 times operating cash flow. And when I was at Hess, if we could buy a company for 5 or 6 times cash flow, they were very high on our target list. And today, it's like I think the average in our Sweet 16 portfolio, which is really high quality companies, the average is like 3.5 times cash flow multiples are what these companies are trading for. And none of them are in any financial difficulty if oil stays, even if it goes to 55, 60, they're still doing quite well.
That was actually my next question. You started partially answering it. So I was going to ask about the companies that are being aggressive right now. So I think there's been a lot of mergers and acquisitions of medium-sized ones in Canada, and then EOG in the last 6 to 9 months. EOG did a sizable acquisition. They were heavily criticized for the oil purchases, but they basically said we're getting profit, free cash flow with the natural gas right now on the assets that they did. And then they said if the oil price rebounds, then we're going to make a lot of money over the next couple of years.
Right. That's the thing to remember. All of these companies produce a lot of natural gas. So not just, 10%. I think our Sweet 16 companies, the average, if you look at it, a barrel of oil equivalent is 40 or 50% of their production comes from the sale of natural gas and NGLs. So 2 totally separate markets. So, okay, the oil price is down below where they would like it to be, but the gas price is going up, and it's going to accelerate into the end of the year. I think before Christmas of this year, we will see $4 natural gas prices at Henry Hub. And if it stays there, and if we have just a normal winter is going to wipe out that surplus in storage pretty quick because you got LNG export capacity. From today, I think it's last week or something, they exported about 17 BCF per day of LNG. And within a few months, our export capacity out of the U.S. is going to be approaching 21 BCF. So year over year in this coming winter, we have an additional 3 or 4 billion cubic feet of natural gas per day that's going to be going out, being exported.
And domestically, Dan, to add to your points there, these massive new next generation data centers that are way larger and much more of an energy hog than the current data centers we have now in major cities and metro areas that are for like Netflix and YouTube and stuff like that. Like we have the ones in Tennessee for Colossus, for XAI, Elon Musk company. Those use only natural gas because there's not nuclear power plants nearby. And then you have the 2 of the ones in the southern states. You have the one in Texas, which is like hours from you, one in Abilene. The first phase 1 of the Stargate project, that phase 1 with the 200,000 GPUs, I think approximately 300 megawatts that's online. But they're talking about scaling this thing up in the next 5 to 7 years to 1 million GPUs and 1 gigawatt of electricity demand.
I know, it's incredible. One of the companies we have in our Sweet 16, I think I mentioned before on your show, Solaris Energy Infrastructure. It was up 15.5% today. It's up 80% since I added it to the portfolio about 6 months ago. And what they do is they build power plants, gas-fired power plants for data centers. Now, these are smaller ones. I mean, but for a company of their size, it's really, really a significant profit margin for them, and they look really good. And they're first-class engineering company and highly respected.
Do they have contracts at the Stargate facility in Abilene?
Yeah. I don't know about that one in Abilene. I don't think so. But they're also building power plants in the Permian Basin just to use that cheap gas out there because they don't have enough pipeline takeaway capacity. So people are building, even operating companies, oil and gas companies are building some gas-fired power plants, small ones, to generate electricity for their own pumps. So they can turn that natural gas that they're giving away for like $1.50 out in the Permian Basin, they can turn it into electricity, so a much more valuable commodity out there.
I get asked a lot by professional investors, hedge fund managers about some of these pipeline companies because they see that the pipelines are going to be required for the natural gas to move the natural gas from either the Haynesville Shale or the Permian Basin to the LNG export facilities to these next generation data centers. Do you see a lot of growth potential and cash flows there?
Yeah, and I think some of them are like incredibly priced. One, I don't really follow the midstream companies that much. We have 4 of them in our high yield income portfolio. The one I really like is Plains All American. It's primarily an oil pipeline company, but they spent a lot of money over the last 3 or 4 years adding more pipeline capacity out to the Permian Basin. Now that capital's all been spent, and they are going to be generating a ton of free cash flow. The stock is trading below book value, which is insane. It plays a very nice dividend. I think it's got a 7 or 8% dividend yield. And they've told me they intend to, raise the dividend. They expect to be able to raise the dividend again next year. So that's a good one to get into. I like One Oak. They do move a lot of gas and NGLs. They're based in Tulsa. That symbol is OKE. Let's see, what's it? Antero Midstream, which is tied to Antero Resources. That looks real good, and it's got a good dividend yield on it. And people invest in midstream companies for yield primarily. So if the Fed does keep reducing interest rates, I think you'll see some investors start looking for other places where they can get good dividend yield.
Are some of the larger pipeline companies that in the past would have been focused on oil, say like Kinder Morgan and Enbridge, that's the Canadian one, but they've been investing a lot into the Permian Basin. Are they starting to align themselves with their investments to focus on natural gas and the data centers?
Yeah, I mean, they're not the ones that are taking it directly to their. I mean, some of these data centers are actually being built in the oil field. They're building them right where they can just take it right from the wells and send it right to them. They just got to, dehydrate it a little bit and get the liquids out of it, and then they can burn it in a gas-fired power plant. It's actually a pretty simple process, but it's very expensive equipment. But basically, you're just burning something to generate, a turbine and generate electricity.
So you mentioned the oil and natural gas companies doing acquisitions. We haven't seen that many acquisitions yet. There were a couple in the last 18 to 24 months. Obviously, you had ConocoPhillips do one. Chevron bought Hess Oil, but that was more for deep water. That finally got approved through the court system. ExxonMobil bought Pioneer. Are we starting to see some other acquisitions now where the companies are running the cash flow multiples, like you were talking about, 3 times cash flow? Are they going and doing that? Because I think there was a lot of acquisitions up for the mid-tier ones up in Canada. Do you think these acquisitions are good, or do you think these companies are waiting before they do more?
Well, there's one that I'm pretty sure is going to close here in December, and that's Crescent Energy. Vital Energy is going to merge into Crescent Energy. And both companies are trading at a deep discount to my valuations. And when that merger closes, it's going to have about 400,000 BOE per day of production. It's got a really good production mix. About 50% of their production is natural gas. I think they're going to also. I think when that deal closes, the timing of that deal when it closes, because I do expect in December we'll see $4 gas early in December. And I think that's going to draw a lot of attention because a lot of energy sector analysts really don't look at these mergers until the deal closes. They don't want to waste a bunch of time on it if they don't think it's going to close. But this one I think is going to close. And then also there's a rumor going around right now that SM Energy and Civitas are going to merge. And both of these mergers that I'm talking about, the Crescent Point one and the SM Energy merger, they are going to become top 10 independent companies, with both of them with well over 400,000 BOE per day of production. And Another thing to remember is size does matter in this business. When you have a much larger reserve base, you have much more access to capital. But the other thing it does is these companies will be big enough that they'll be considered for an addition to the S&P 500 index. And there's so many of these index funds. People are pouring money into these index funds like crazy. And so if they become an S&P 500 company, those funds have to buy those stocks, which will, run up their share price or should run up their share price. So the combination of, and both of these mergers are companies that do have a lot of gas production. SM Energy and Civitas, they would have core areas in the Permian Basin, the Uinta Basin, and the DJ Basin. And the DJ Basin has a lot of gas, and they have good markets up there for their gas also. So they get decent prices for that gas. So I like both of those deals if they go through. So we'll see, but I'd keep an eye on those two.
So you're talking about growth when these companies actually merge, but when a large company like ExxonMobil or Chevron or ConocoPhillips, when they do an acquisition, don't they kind of slow down the amount of they fire employees, right? Because you don't need two mergers and acquisitions departments or two accounting departments, so they start to let go some employees. They start to cut capital expenditure. So are we seeing that with like ExxonMobil, where post Pioneer acquisition, which was massive, are they like cutting a lot of the capital expenditure budget and they're slowing down the growth projections?
Yeah, when two public companies, join forces, you're gonna have a headcount reduction for sure, and then they're also going to look, and they may be selling off some non-core assets to quickly pay down the debt. I mean, that's what we did. We buy the companies, and we were really looking at maybe we wanted about 80% of the assets, and we would immediately sell the stuff we really didn't like. Just to get rid of it. You don't care about it. So if it's not in your core areas, you can get rid of it. But anyway, there's always going to be mergers and acquisitions. I've been doing this for a long time, and it's like every year I put out a Sweet 16, and by the end of the year, 2 or 3 of them have been acquired by somebody. I used to have Pioneer in there. I could not believe when that one went through. I would never have guessed that one happening. So actually, I'm hearing rumors that Exxon is taking a hard look at Diamondback Resources, and I can tell you that would be a $60 or $70 billion deal. If they announce that deal, that's going to be a big announcement on Wall Street.
That's kind of surprising, but I mean, like, Royal Dutch Shell, ExxonMobil, Chevron, there were rumors they were looking at BP. I guess they decided for now to not bid on BP.
Yeah, those are big, complex deals, because they're not just, like Diamondback is a pure upstream company. It doesn't have a bunch of midstream assets. It doesn't have it's got a very clean company. It's a pure play on the Permian Basin. 2 others Permian companies that both of them I updated my forecast models on today, Matador Resources and Permian Resources, are both about 200,000 BOE per day. First of all, I would love to see those 2 companies merge. I really like them. They have some outstanding acreage in the Delaware Basin, and if I was at Hess, I tell you, these guys would be on my hit list to go after.
So I want to talk about growth for oil and natural gas. You already talked about the growth for oil. We talked before we started recording. You think that the growth picture long-term for natural gas is far stronger than oil. Could you maybe talk about some of the projections for natural gas demand growth?
Well, the problem with natural gas is, you can't truck it out. You have to be able to hook the wells to a pipeline. We could increase our production really quick, but we don't have enough pipeline capacity to move it. So, actually, one of my slides I brought up now that I spoke from a couple of weeks ago. LNG from the end of 2024 to the end of 2026, LNG export growth is going to increase 5.6 BCF per day. Then you get an additional 1.6 BCF per day as more pipeline capacity going into Mexico from West Texas. We're exporting gas into Mexico. And then just power burn industrial demand is going to go up for electricity generation and just other, feedstock and stuff will increase by 3 BCF a day. So you add all that together and you get a 10.2 BCF per day increase in 2 years. Well, because of pipeline limitations, we can only increase production by about 5 BCF per day. So there's really, if we just have a normal winter, we have enough gas in storage this year to make it through a normal winter. But if we would have, some big polar vortex thing or something happen early in December or January, and it's a La Nina winter, so that's when you have these big polar vortex events. If we have that, it will wipe out that surplus in storage like within a day. Last year, which was considered a mild winter, the winter of 24-25 was considered a relatively mild winter. We had 4 weeks where the draws from storage were more than 100 BCF above the 5-year average. And so we're running, I think the storage capacity right now is about 150 BCF above the 5-year average. But looking backwards at the 5-year average doesn't really take into consideration how much gas demand has increased. So it's really a flawed comparison to say, well, look at the 5-year average, we're way above. Well, we're in a world where natural gas demand in the U.S. is ramping up much faster than the 5-year average. We're having increased demand for natural gas go 5 or 6% year after year, and all that demand is locked in from now to 2030. The LNG export facilities are going to be built. The AI data centers are all getting built. All this other stuff, just commercial industrial demand is going up. And every house that we build across the whole South and East, they heat their homes with natural gas. So just, heating demand goes up year after year after year. It's just such a strong market because it's the cheapest energy on earth.
Well, also with the data centers, I mean, I've seen projections all over the place.
Yes.
It's tough to know because the construction might not be on time and on budget. Like the phase
Right.
1 for the Stargate data center in Abilene, Texas, that is online, but they're planning additional phases to scale it up even more than that. They also announced additional plans to build these data centers in the Midwest, I think, and then Google and some of the other tech companies, Google, Meta, Amazon. There's tons of other tech companies, at least 5 other tech companies with Oracle and NVIDIA involved, and OpenAI and some of the other companies. They all want to build data centers of at least, like, I would say 200,000 GPUs, which are around 300 megawatts of power, but they're talking about scaling it up, Dan, to like potentially 1 million GPUs, I said, by the early 2030s. So I don't know if we're going to get there, but the people seem to think that are building these data centers right now that are coming online, the Stargate one, and then also the Colossus one from XAI, they seem to think it's feasible that we can scale 5 to 7 years from now from 200,000 GPUs up to 1 million. I mean, like the amount of natural gas, I've seen projections, 14% growth per year if that stuff plays out like they're projecting.
I know. Well, I saw something a couple months ago that there's 8 or 10 AI data centers that are going to be being built in Appalachia. That's the Marcellus Utica play in eastern Ohio and Pennsylvania. So the AI data centers are going to build because they know they can't build them like in, Virginia and expect the pipeline to be built quick enough. So they're going to build those data centers right in the middle of the gas fields. That you're going to see a couple big ones built in Mississippi that have been announced, really big ones, and 8 or 10 being built in Appalachia. And we had a very small Canadian upstream company called Pine Cliff Energy, and they've already signed a contract with an AI data center to be built in their largest gas field, and they've already got that contract in place, and they're hoping to get 2 or 3 more of those in place in the coming years. So they're looking north because natural gas up in Canada is even cheaper than it is in the U.S.
So for listeners out there, I'm sure they've seen all the headlines and some of the articles talking about like nuclear power and data centers.
Yeah.
But the reality of the situation, Dan, is that unless the nuclear power plant is right there and they have an expansion permit to maybe build another cone and bring that online in the years to come, you have to build the data centers. If you're going to get the data centers online quickly, they have to have natural gas supply, not nuclear.
No, they have. It's the only short-term solution that I see. Because the grid, they're saying in Texas, we're not going to be able to hook them up to the grid because we don't have enough grid capacity. And, you hook up these big data centers. Let's say you hooked up one, run around San Antonio or something, and they need power 24/7. So you're not going to be able to do that because the
Do you
retail
think that
customers.
means so if they're not hooked up to the grid, do you think that means that the governments then are telling the tech companies that you have to pay for the separate electricity substation, you have to
Yes.
pay for all the pipelines, that the taxpayer, the government is not going to pay for any of that?
Well, I mean, the market will take care of that, but the data centers must have reliable power, and the only way to have a reliable, 7 days a week, 24 hours a day, 365 days a year, is to build your own power plant where you control it, and it's right there, and you're not going to have blackouts or brownouts if you run your own power plant, and that's what SEI does. They right size power plants for these data centers.
Oh, or do you cover that company? It's in what, the Sweet 16?
Yeah, I cover it. It's very profitable. Every time they do a quarterly announcement, they update us on how many more orders they have, and they really can't keep up with the orders they've already got. So their upside is incredible. It was up 15% today. it's my I looked at it like 2 months ago when it was trading in the like 30, and my valuation was $42. It just blew right past that. It's at 52 now.
Well, a lot of the institutional investors, they are not necessarily buying Nvidia. They're actually looking at the infrastructure, because I don't know if you've seen some of the
Yep,
charts,
right.
some of the charts showing basically these data centers are extremely complex. For the cooling systems, you need a lot of energy usage for the cooling systems. There are energy hogs, there are water hogs, and these racks of the GPU servers. I mean, they're over 2,000 pounds for these Nvidia Blackwell chips per rack. And yep, you burn through them. You have to keep them cooled off. So you're burning tons of electricity for a bunch of different things.
Well, I think MIT put out a report that said they don't see how these AI companies are going to ever make enough money to justify their share price. Now, of course, I said that about Amazon 20 years ago or so. But so you look at a little company like SEI, and they're clearly profitable. I mean, they're extremely profitable now. They're generating free cash flow now, and they could get all the funding they want. The bankers are happy to loan them money so they can get more of this stuff going, and it's incredible.
Well,
And so, people are looking for ways, like you said, to invest in the people that are going to really be making money off the AI build out. And that's why I think there's a lot of company investors looking at this. And when you have companies like this that jump out, let me look at what their trading volume was. I think it was massive. Yeah, their normal trading volume, which is big for this company, it's only got like 65 million shares outstanding. Their average volume is like 2.6. Today it was close to 5 million shares traded hand. That's a huge volume for a company of this size.
so it sounds like a pension fund or an institutional investor started to open up a position in the stock. That's what it sounds like.
Yeah, that's right. Yeah. So,
It's a
and it pays
larger,
a dividend.
larger.
And it pays a dividend. I mean, the dividend yield's low, but it does pay a dividend.
Yeah, so I agree with you. I think a lot of the software companies that are designing the artificial intelligence software, all the different versions, I think they will not be the main beneficiaries. I think it's going to be like the energy companies, the utility companies,
Right.
the infrastructure companies that are involved in constructing the data center, where all the many billions of dollars of capital expenditure is being spent right now. I think those are going to be the main beneficiaries.
Yeah, I bet you there's some construction companies that are going to be making a ton of money off these things. You know that because the, the they've got so much money invested, hundreds of billions of dollars invested. So, and they have to meet these deadlines. They have to get these data centers up and running. So they'll pay whatever it takes. It's not like, it's like money's no object, but they've got to get these things online to justify their existence.
Well, did you see what Meta is doing? Meta has been building these things with tents, and then Meta just put out like an Enron type guarantee that any like construction overrun costs, that Meta will subsidize all of it. Literally,
Wow.
like almost a blank check from Meta. And then Mark Zuckerberg did a podcast interview. I mean, I don't know. I'm sure his board of directors is angry at this. He basically said that, like, I don't care what my board of directors thinks with profitability. I'm committed to spending like $600 billion of capex for data centers and AI software to improve it, with his like glasses, the Ray-Ban glasses and the other
Yeah,
glasses,
yeah,
the VR stuff, by the end of 2028. $600 billion. That's just
yeah.
one company.
Yeah, the numbers are crazy. I mean, the oil and gas business is a very capital intensive business, but I tell you, this AI data stuff, data center stuff and these AI companies, I mean, I can't get my arms around the amount of money they're investing in this and how they're going to pay it back. I don't get it, but maybe. I mean, they're smart people, but
Well, I mean, I think they'd love to build nuclear power plants, but it's just not efficient to build a nuclear power plant quickly here in the United States. It's
no.
not like China where you can build 9 or 10 nuclear power plants a year. The US is just way too slow. It takes way too much capital and rules, regulations, red tape, construction overruns. I think the nuclear power plants in Georgia, they ended up costing over $10 billion more, and there was many years of construction delays.
Yeah. And the thing about natural gas is you can right size the power plants. You know, we generated our own power for a big CO2 flood we had out in West Texas when I was at Hess. And it basically was 3 jet engines that were hooked up to generate electricity for the whole field. And we have 500 or 600 wells in there. They're all on pump jack and everything. So we needed a lot of reliable electricity. So, but you can right size for what it was. Actually, if your listeners, if they go to Solaris Energy Infrastructure's website, it's SEI as a symbol. They have a really good presentation that explains kind of how they do it and how they right size the power plant for the needs of their customers. It's really cool. It's really a cool company. Anyway.
So as we wrap up here, I want to ask you about low-cost producers, free cash flow, growth companies. Which companies do you think are doing a good job navigating these relatively low oil prices, keeping costs low, maybe making smart acquisitions that you cover in your Sweet 16?
Well, one company, now these guys are outspending their cash flow because they've got a tremendous asset in the Duvernay Shale. Spartan Delta Energy, it's SDE.TO. Now, their current production is about 75% natural gas, which is a good thing, right? But they've got a lot of upside on the oil side. And that stock is up about 50%, but it's still trading at about half of my valuation. And they have a partner. They have a 20% partner in the core area of the Duvernay. It's called Journey Energy, and that stock's up about 30 or 40%, but it still has a lot of upside. I also, I like natural gas. I like, and this company is building, it's a very low cost producer, very profitable company, Riley Exploration Permian, symbol REPX, and they are building 2 of their own natural gas fired power plants to generate the electricity for their own operations. They're way out in West Texas and in Eddy County, New Mexico, which is in the southeast corner of New Mexico. They've got a new core area, and the gas market is terrible out there. Literally, you can only sell your gas if you're lucky for $1.50, because there's just so much more gas than there is pipeline. So they're going to turn that gas into electricity, and they're going to build these things big enough to generate all the electricity they need, and they're going to sell electricity into the Texas grid. So they'll be making money off the electricity sales as well. So I really like that one. That was pretty cool. And let's see, another one. One of our top picks is still Calibre. The company has a pristine balance sheet. They're doing everything with free cash flow now. Its symbol is KGEI. It's really a one asset company. It's a very, very small company with about 5,000 BOE per day of production, mostly oil though. For natural gas, the little company I mentioned, it's Pine Cliff, based in Calgary. Symbol is PNE.TO. The stock's only 70 cents Canadian. My valuation is about 95 cents. But if natural gas price goes up, it could go way up. Last time natural gas up in Canada was about $3 an MMBTU, this stock got up like $2. So if gas prices bounce up in Western Canada, it could be a double from where it's trading right now.
And I think they're also talking about, now that they've started building out some of these massive data centers in the US and talking about additional ones in the Midwest, they're talking about building them in Canada too, because there is that cheap natural gas, like you said. I've just heard in the last month or so, they're talking about now, since natural gas is so cheap, why don't we put, and Canada is colder, that would save them some money on the cooling costs. Why don't we put some data centers up in Canada then?
That's exactly right. I said, when they started looking at it, I said, hey, wait a minute. All we have to do up in Canada is open the windows. It's pretty cold up there right now.
Yeah, I mean like Norway, so like Norway or Iceland,
Yeah,
some of these other colder countries that have like geothermal or other stuff,
yeah,
like it makes sense to put some data centers up there too.
yeah. It does. Anyway,
Well,
yeah,
last question here. Now, I've seen some negative research coming out predicting that potentially there will be a natural gas supply glut for liquefied natural
yeah.
gas exports by like early 2030s. Do you agree with that, or do you think that's inaccurate?
No, I'll worry about it then. I I truly think, people have been talking about natural gas to be the transition fuel to where we can transition to where all of our electricity comes from wind and solar. That's not happening. That is not going to happen. Natural gas is the future. It is the future. Eventually oil prices will go high and oil fields do decline, and if just demand in general for electricity just keeps going up, 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 the only solution that I see is natural gas for the next 5 to 10 years at least. So I don't think that's a problem until way down the line, and I'll believe it when I see it.
Well, the supply glut has to do, I think, with how I think China and Russia just
Yep.
announced that China doesn't want to buy as much expensive LNG imports, and that I think Russia is going to be building them what a Trans-Siberian type of massive natural gas pipeline to try to pipe gas from Russia into China. So that will allow them to reduce their LNG exports. But I look at Europe, and Europe has a lot of oil and natural gas drilling bans. They basically have to buy natural gas from either the US or Norway or Qatar. So they have to buy it from somewhere because they don't allow domestic oil and natural gas drilling. And then Europe is also like the United Kingdom and Europe, Dan, they're really far behind on the artificial intelligence and data center build out. They're going to want to catch up, and they're going to want to start building these data centers. And that's going to cause even more natural gas demand in the future.
Yeah, I think so. It's a clean burning. I mean, it's so clean burning. A natural gas fired power plant almost has no emissions. I mean, compared to a coal fired power plant, it probably has 5% of the emissions of a coal fired power plant. We have one, I drive by one all the time, coming home from the health club, and it's just a bunch of steam coming out of the thing. That's it.
Well, but the green energy people, the ESG people, Dan, a lot of them, if they're not scammers, they're hypocrites. So a lot of them don't even understand, like they say about how clean or green solar panels and wind turbines are. But I mean, like the reality, and we're going to find this out now with rare earths because they're being talked about constantly in the news, is how like highly toxic all the chemicals are for rare earths mining. Like it destroys the air, water, and soil. So to say
Yeah.
that, to label and say these things are green, I mean to get the rare earths to make solar panels and wind turbines, like it's insanely environmentally unfriendly. Excuse me.
Yeah, there's nothing green about wind turbines. I could tell you.
Or solar panels, yeah, or solar panel.
Or even solar panel. I mean, the mining costs and the pollution of the mining operations to get the materials you need them, to build them, to haul them, to install them. You got to add all that up, and all that all that work is done by machines that are run on diesel. So
Well, also they don't talk about this a lot because a lot of these rare earth experts, I'm using air quotes, they're Johnny come latelys. I've been covering rare earths for many, many years. There's huge radioactive byproduct with the rare earth elements there for uranium and thorium as a byproduct, and then also like you're using an insane amount of highly toxic chemicals to separate out the rare earths, to
yeah,
separate the radioactive materials out of that, and then you have to store the radioactive material. So, and then on top of that, you have to turn the rare earths that you mined at the mine site after you destroyed the air, water, and soil around there for miles. You have to turn that into viable products, and that's
mhm,
like very energy intensive and lots of chemicals too.
yeah. Well, if any of your listeners, want to contact me, I'll send them my last newsletter or something. They can kind of see what we do. Just send me an email at energyperspectives@gmail.com, and we'll just send you a newsletter and tell you what we want to do. And if you have interest in any of the companies I mentioned, just let me know. We do updated profiles on all these companies and detailed forecast models on all of them.
And if I could add to your points there about valuations for the oil and natural gas sector, I mean, we are in terms of sentiment. I mean, in the last like few months, the oil longs for on the oil futures contracts, I think we're at an all-time low for oil bulls. It was like the most bearish sentiment, I think, on record. And so like what the XLE, which is what the S&P 500 portion of the energy sector, I mean, that's disproportionately low compared to a lot of the other industries.
Yeah, like EIA comes out with a forecast in their short-term energy outlook forecast from last week, and they lowered their oil price forecast for Brent down to like 53 or something, which would put WTI at 50. And
Who
look at
makes
the
money?
strip.
Who makes money at those prices?
Look at the strip, the NYMEX strip today. So the oil traders obviously don't believe that because the strip is all the way for the whole next year is like 57 or 58. So they're going. I don't know where EIA is getting that, coming up with that number because the real world supply and demand is pretty tight, and it definitely does not justify oil going down another $8 or $10.
Well, another $8 or $10. I mean, you're at the marginal production cost for a
Oh
lot of
yeah,
producers. It makes no sense to produce oil and lose money.
yeah. If that would happen, you would see these upstream companies just slam on the brakes on their drilling programs like crazy. And then what would follow that would be the same thing we saw with the pandemic. You would see a big decline in U.S. production in a very short period of time, and it would be extremely difficult to rebound from that because a bunch of people would lose their jobs. The service companies would be in big trouble too. And they're not just you don't just have big, expensive, great drilling rigs sitting around in some Walmart parking lot someplace. This is an industry that is really hard to ramp up if you let it go down.
Yeah, especially deep water with a lot of additional
Oh
oil
yeah,
production. I mean, because if the oil prices go low, they just start scrapping all the old deep water rigs. They just shut them down or
yeah,
decommission them.
yeah. There's still a lot of potential in the deep water, no doubt about it. But those are long-term projects. They don't happen overnight.
Oh yeah, I agree.
Yep.
Yeah,
All
so
right, man.
so so we're basically at a sentiment standpoint. I think risk reward valuations, I think for a contrarian standpoint, oil and natural gas companies are probably the cheapest of any commodity sector right now.
No, they literally look good. I can tell you. I got some great companies that are very, very profitable companies trading at extremely low multiples right now.
Yeah, I think from a valuation standpoint, I think they're by far the cheapest. Now, I think we could see gold at $5,000 an ounce in 2 years or less.
Wow.
So I think the gold stocks, because I have a friend who's an oil hedge fund manager, and he keeps, saying that the gold run is over. And he said that like 4 or 5 months ago, and I was like, no, the gold run's not over.
No.
The gold run's not over. The gold run's kind of like it's based on all these other currencies and government debt like being destroyed. They're intentionally devaluing these things. So I could
Yeah.
see gold at $5,000 an ounce in 2.5 years, or maybe even less. We'll have to see.
Hey, one of the little mining companies that I follow up in Canada, it's not really that little. It's called Nouveau Mont Graphite. They have a big graphite discovery they're developing, and they got Panasonic and GE and General Motors are invested in the company now. The stock was up 50% today in one day.
Well, I think that's because I think China just announced that they're banning some graphite exports. So I think that's why. So I think
Yeah,
people are
that's it.
scrambling, looking around for reliable supply for Western countries like in the U.S. and Canada. I think that's why.
Yeah, and their discovery is huge. It's all been confirmed. This is a very big discovery. It's going to take a couple of years to get the mine online, but they've definitely got huge resources. The symbol on that one is NMG. I think they recently listed on the New York Stock Exchange too. I haven't looked at it closely in a long time. Anyway,
Well, and graphite, I mean, a lot of it depends on graphene. So graphene
yeah,
demand for manufacturing. So we'll have to see. We haven't had the graphene batteries yet in the smartphones because I know in the labs those were testing pretty well like 6, 7, 8 years ago, and they haven't manufactured those and added those into Samsung or Apple iPhones, Samsung smartphones or Apple iPhones. Kind of shocking.
yeah.
Okay.
I'll send you one when I find it. I can't think of it offhand right now, but one of our members posted about a graphene company, and I think the stock is up like 300% since you mentioned it. I'll send you that later.
Okay, well, thank you so much for your time and keep up the good work at Energy Prospectus Group. For our contrarians out there who have wanted to take some profits in some of your gold stocks and look to diversify into cheaper markets with better risk reward, the oil and natural gas sector, the pipeline companies, the low cost oil producers, some of the low cost natural gas producers in the US and Canada looking like good risk reward contrarian value plays right now.
All right, man. Thanks a lot.